There's an old adage that says, when asked how much you should give till it hurts. Well, what if we can think of ways that you give that much, but it hurts a hell of a lot less? Today, let's talk about charitable giving.
Hey, dear listeners, we need to let you know that Kevin and Stephanie offer investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations to any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Now let's get on with the show. This is Take Back Retirement, the show that's redefining retirement for women. Retirement is an old-fashioned cultural concept. We want to reclaim the word so you can make it your own. I'm Stephanie McCullough, financial planner and founder of Sofia Financial, where our mission is to reduce women's money stress and empower them to make wise, holistic decisions so they can get back to living their best lives. Kevin Gaines is my longtime colleague with deep knowledge in the technical stuff, investments, taxes, and retirement plan rules. He's a little bit geeky and quantitative. I'm a little bit touchy-feely and qualitative. Together, through conversations and interviews, we aim to give you the information and motivation you need to move forward with confidence. We're so glad you're here. Coming to you semi-live from the beautiful West Lakes Office Park in suburban Philadelphia, this is Stephanie McCullough and Kevin Gaines of Sofia Financial and American Financial Management Group. Say hello, Kevin.
Hello, Kevin.
We are recording this in January of 2026, and often having just come through November and December, which is a time when people tend to focus a little bit more on giving to the causes that they care about. We're not going to say anything about the political environment and how that might affect things. However, one of the reasons it becomes a calendar year thing is because of the taxes involved. And that's kind of the crux of why not all dollars are created equal when it comes to charitable giving. And while a lot of our conversation is going to talk about taxes today, I want to be clear that taxes are just the mechanism. What we want to do as individuals who are trying to give to a good cause is to try to be as efficient as possible, to get as much leverage, to have the most bang for our buck, so to speak, in the way that we give. The dollars that come to a charity, Kevin, they don't care where they come from, right?
No, charities pay 0% tax rates. So to them, all dollars are the same. Now, it matters to them if they get it today or 10 years down the road, but to them, it has the same level of cost, if you will, which is 0%. It's how it impacts you.
Yes.
That we're is where all of this conversation is going to apply.
And honestly, a lot of our clients who are looking forward to quote unquote retirement and older age and longevity, they're a little bit uncertain about whether they can afford to be generous with their dollars. If you're not sure you have enough for you, how are you going to feel comfortable giving some of those dollars away? So again, this is about intentional generosity, how you can hopefully be generous and also not endanger your own nest egg, your future stability, and perhaps your legacy.
Right. And I do want to take a quick moment, since Stephanie, you're normally the adult in the room, so to speak, when it comes to saying things that keeps our compliance department happy. I do want to say two things real fast. First of all of our conversation today, we're going to be talking about the federal taxes. We're talking about the IRS.
Mm-hmm.
Every state has their own set of rules, assuming they even have state income tax.
Right.
That could add a little nuance to the conversation about what to do here.
And some cities too.
And some cities as well, absolutely.
Mm-hmm. So check with your experts on the local stuff, right? That's that point.
Absolutely. And the other thing is tax laws are always changing.
Yes.
New laws come into being, IRS issues new rulings or whatever. So everything we say today is true. Will it be true next week? Who knows? So please, before you go, oh, Kevin and Stephanie said this, take 30 seconds, double check to make sure the rule is still the same.
Yes, please. Good point. Thank you, Kevin, for covering our butts. Okay, so let's be honest. When most of us think about giving to charity, we think about pulling out our checkbook, or we see someone's appeal on Facebook. They're doing a charity run. You type in your credit card, right? The default way of giving for most people is cash.
Yes. And it's the easiest thing to do. And they're quick, they're easy, they're simple.
And honestly, right? The tax code has been written in large part to give incentives, right? To incentivize our behavior. And most of us think, oh, I'm giving to charity. I'm giving to a nonprofit. That means I'm getting a tax deduction for the gift. Now, Kevin, the rules on that tax deduction for cash gifts to charities have changed as we sit here in 2026, right?
Yes. So there's two big changes. The good one is there's now what they call an above the line deduction for charitable contributions, 1,000 if you're single, 2,000 if you're married filing joint, which says if you just take the standard deduction, you do not itemize, you can write off the $1,000 or $2,000 off your taxes, and you don't have to itemize to get that deduction.
Which is
they
new.
did that back in the COVID years, and everybody seemed to like it, so they brought it back.
So keep track of those contributions you make.
The second one, less good. In fact, not good. They added a floor to your charitable deduction if you itemize. So when you're filling out and you say, I donated $10,000 to charity, they now have a floor similar to what you have with your health expenses when you itemize. You have, you got to have at least X amount in order to get the deduction.
A certain percent of your taxable income, right?
Yeah. And for charity, for the charitable deduction, it's 0.5%. So this new rule in 2026 says if you itemize your charitable deduction, the first 0.5% you don't get to deduct.
Of what? Percent of what?
So this 0.5% is based off of your adjusted gross income, commonly called AGI. And that says if you earned, say, $100,000, you have to donate at least $500 before you get to claim the itemized charitable deduction.
So in essence, those first $500 are not deductible. Is that right?
Correct.
So if you're given $50 to the charitable run and you itemize for your taxes, you don't take the standard deduction, you don't get to deduct that anymore in 2026, right? That's the new rule.
That is correct.
And if your income's a lot higher than $100,000, then that 0.5% is a lot higher too.
Absolutely.
Okay. So we just wanted to make that point that it's no longer an automatic, I wrote a check to my local SPCA, it's deductible. You got to do a little bit more checking out, right?
That is correct.
All right. Anything else on cash? So if you think about it, right, if you're giving, you're writing $1,000 check to the charity, they're getting $1,000. It's kind of costing you $1,000, right? It's $1,000 less in your bank account the day after the check clears. But the other idea, and this is something that's, fairly common we see with people, you can donate what we call in the business an appreciated asset. What the heck does that mean, Kevin? What's an appreciated asset?
You actually bought something that went up. Congratulations. You picked the correct stock, bond, bought the right piece of land, whatever. So
mutual fund, piece of art, whatever.
Yeah. Think of it this way. If you sell it and you pay a capital gain tax on the appreciation, it's an appreciated asset. And that's what we're talking about in this section.
Let me just back up and explain that a little bit and remind people. If I, for example, when my daughter asked for an iPod many years ago, and she already had an iPod, yes, this was back in the iPod days, I bought her 2 shares of Apple stock. And they were maybe, I can't remember, $90 each. And then when we went to sell the Apple stock, because we were dopes and didn't hold on to it forever, it was like $250 each. So we owed capital gains on the difference between $250, the current value when we sold it, and the $90 that I paid for it. That difference is called the capital gain. You owe a capital gains tax on that difference in the year that you sell it, which is usually for most people 15%.
Correct. And here's the headline on appreciated asset donation. You donate the appreciated asset, you avoid the capital gain tax, and you get the credit of the value of what you donate, not what you paid for it.
Mm-hmm.
So you buy $10,000 worth of Apple stock. It went up to $100,000. Caveats aside, you could donate that $100,000 worth of stock. You get a $100,000
tax deduction, but you only paid $10,000. That's a pretty good freaking deal. I don't care how you do math. The charity gets the $10,000 of stock. They sell it. They owe no capital gains because they are a tax-exempt entity. They have $10,000 to spend. They're happy. You're happy. That's basically how it works.
Now, to be a little bit of a downer, I do want to point out a couple little things to be aware of. First of all, it needs to be a long-term gain. So if you happen to buy a stock 2 weeks ago and it triples overnight on you, hey, sometimes you get lucky. What can I say? You don't get to donate that and avoid the capital gain.
Long-term gain kicks in after 1 year of ownership.
Exactly. And the other restriction they have, going back to the old AGI that we just discussed, appreciated assets, that deduction is capped at 30%.
Of your
and
AGI.
In some cases, it's only 20%. But in most cases, it's a 30% cap. So if
going back to your example of your $100,000 of AGI,
you can only deduct $30,000
of this appreciated asset strategy.
Correct.
Right.
Yes.
So if you happen to own, like, we keep changing our numbers, so I apologize. But if you had a $50,000 asset that you wanted to donate, you could only deduct $30,000 of it. But you could do $30,000 this year and $20,000 next year, right? That's something we often see with these tax rules, splitting it between tax years too.
Or the other way, going back to one of my favorite topics, is you can increase your income. Just for clarity, increasing your income is not my favorite topic. Roth conversion. You have this big appreciated asset you donate, but you're capped at 30%. You're going to leave some money off the table, on the table, however you want to phrase it. But you pair that in the same year you do a Roth conversion. You have to pay tax on Roth conversion.
Roth conversion, Kevin's talking about, we'll link to the other episodes. We're talking about an IRA, an individual retirement account you owned, and then you decided to convert it to a Roth IRA, which means that increases your taxable income in the year you do it, but then in future you never pay tax, right? It can be a really fun thing, attractive thing to do. That's what he's talking about. Continue.
And maybe as a little side note here, Stephanie, maybe a future episode will be an episode on everything advisors assume everybody knows, but nobody knows, since I've already been called out on saying AGI, capital gains, Roth conversions, and that's just in 10 minutes of recording?
That's my job. That's why I'm here. I don't think one episode would cover it, Kevin. I think that's basically our whole podcast. So I had just suggested that perhaps one way to get around, if you wanted to donate more than you're allowed to deduct in 1 year, was to split it between different years. There's another strategy that affects the timing of your donation, and it's called a donor advised fund.
So yes, you can donate this money, these appreciated assets, directly to charity. Or if you don't know what charity you want to give it to, you can put it into a DAF. Stephanie, are you going to correct me on not saying what a DAF is ahead of time?
Some people even say DAF, which I think is worse. We're talking about a donor advised fund. A donor advised fund is a really interesting vehicle. It's actually a charity. So the donor advised fund is a 501c3. It's a charity. And at the same time, it's kind of a conduit where you stick your money into it in one tax year. To me, it's all about timing, the donor advised fund, and flexibility, of course, but it's really timing. So you might, in a particular year, and we'll talk about the reasons why, but you might want to give a big donation in one particular year. You give it to the donor advised fund. You're giving up ownership of it. The charity, the donor advised fund, now owns it. So you get the tax deduction for everything you put into the donor advised fund in the year it goes in there. And then it can sit there for many years and you can dribble it out over time to make your donations to charity. Now, if you get your big deduction in year one, and then in year 2, 3, and 4, you give to the local SPCA, you don't get deductions in year 2, 3, and 4, right? You already got your deduction in the year it went into the donor advised fund. What did I miss?
Correct. So, and that's really the big thing on donor advised is because you want that deduction in this particular year.
Right. Why might that be? Like, show us a couple scenarios when that might come up.
So what happens if you get a big bonus at work?
Mm-hmm.
Or what happens if you get, hey, it happens. People win the lottery.
Or a friend of mine had worked for a company that gave her some stock. And then they had a liquidity event, as they say. The company got sold and she had a big taxable year one year, right? This happens. Or you inherit an IRA and you got to take a big distribution, right? Like there's a lot of reasons you might have a big taxable, big high income year, which, right, to play that out, the issues, that might put you into a higher tax bracket. Obviously, if you have more income, you're going to pay more income tax. So you might want to reduce that taxable income by a deduction.
Right. So, and there's other reasons, especially if once you're retired or once you're above a certain age, shall we say, that you got to worry about Medicare, IRMAA surcharges.
Yep,
you're
we'll link to our
preparing to
episode
get
on
financial aid for college education.
Mm-hmm.
There's lots of reasons you want to lower your income beyond just, I want to pay less taxes.
Right.
That donor advised fund, that big bunching could be well-timed in these situations.
The other place I see it coming into play now, especially with this new rule around the AGI, the 0.5% floor, let's say you make $100,000 as your adjusted gross income. You usually give $500 a year. You're going to be under the deductibility limit. If you're in a position to, you could put $5,000 in a donor advised fund. You get the deduction for everything above the 500. And then in the next 10 years, you give your $500 a year from the donor advised fund, right? You got your deduction.
And the other potential advantage for compliance reasons, potential advantage of using a donor advised fund is the money's invested while it's sitting there. So this $5,000 contribution, maybe it grows to $5,500. You get an extra year of those $500 donations you're making, for example.
Yep. So it's an interesting vehicle, right? It's not a panacea. It's not a one size fits all, but it's something to know about to see if, it might be beneficial to you. Our next topic is also not a one size fits all because you have to be a certain age to do it. Kevin, what's a QCD?
Qualified Charitable Distribution.
Kevin is smiling ear to ear for those of you only on the audio. This is one of the things he loves to geek out about.
You listen to more than 2 or 3 episodes, you're going to realize when it comes to talking about IRAs, yeah, you're just going to put a little extra pep in my step, shall we say.
So QCDs related to an IRA?
To an IRA. And that's the first point, to an IRA, not to a 401k or a workplace retirement.
Or an investment account.
Or investment account, yes. Now, QCDs are different than everything else we've been talking about and we'll talk about after this segment, which is you don't get a deduction for doing a QCD. Well, why would you do it? Because it doesn't count as income. So here's what happens with the QCD. You take the distribution from your IRA, it goes to the charity.
Directly.
Normally, when you take money out of your IRA, it counts as income.
Mm-hmm. You're going to pay income tax on that.
Right. Problem with income, especially if you're over, say, 65 and you're worried about Medicare IRMAA surcharges, which is extra Medicare premiums you have to pay if you earn over X amount of dollars, or you're collecting Social Security. Well, at certain income levels, your Social Security is subject to taxation.
Mm-hmm.
And taking distributions from your IRA is a good way to get into those situations.
Well, and just the most basic thing is that money coming out of, and we're talking about traditional IRAs here, not Roth, money coming out of an IRA, you're going to pay income tax on, right? There is a point at which, and it used to be the same age and it's no longer. Now it's when you hit age 73 and then it'll go up to 75. But when you hit 73, the IRS says, we've waited long enough to get our tax dollars. Little taxpayer, you got to start taking money out of this IRA. And there's a calculation to figure out your required minimum distribution, RMD. We'll link to episodes where we talked about that. But those numbers can sometimes get large, right? If you followed the traditional advice and stuck as much money as possible into your 401k while you were working, and then you rolled it over to an IRA, your RMDs can be more than you need to live on. They can kick you into these higher tax brackets. They can kick up the IRMAA surcharge. So the QCD, the Qualified Charitable Distribution, again, it used to go hand in hand timing-wise, but it no longer does. But it is a way to not pay tax on some of that income because some of it's going to go direct to your favorite charity.
Correct. Yes. So when you're asking why QCD starts at 70 and a half, like you just said, Stephanie, it was because that's what the RMD age was at the time when they created QCDs. And fortunately, as they increase the RMD age, they have not increased the QCD age. So, and hopefully they never will, but hey, with Congress, all things are possible.
So this is, one of the reasons that we sit down with our clients and we're doing projections, and that our projections take into account tax planning, because it might be that, again, people are following the traditional advice. Oh, don't tap your IRA until you have to, until the IRS says you must. But then when we start looking, maybe in their 60s, and we say, oh my goodness, you're going to have some high taxable income down the road. Why not? You turn 70 and a half this year. Why not think about a qualified charitable distribution? And honestly, this could be, hey, I always give a certain amount of money to my favorite charities. Well, let's do it from your IRA now directly instead. Or it could be, I've always wanted to be more generous. I wish I could. Well, hey, here's a way that could be super tax efficient and have other benefits down the road for you to give maybe more than you felt like you could in the past.
Now, as good as QCDs are, and generally speaking, QCDs is probably one, especially if you're older, is one of the best ways, or one of the most tax efficient ways to give.
Mm-hmm.
But there's a couple catches. The biggest one is, even though the amount you give can be used to offset your required minimum distribution, it cannot satisfy all of your RMD if the RMD is big enough. There is an income limit on how much you can do on a QCD each year.
A dollar limit.
Dollar limit.
Yeah.
It used to be just a flat 100,000, but starting in this last tax bill, they started indexing it for inflation. So I think right now it's like 106,000 or something like that.
I feel like it was even maybe a tiny bit more now, but yeah.
Right.
So you could give more from your IRA, but it's no longer going to have that QCD treatment on your tax bill. So you do want to pay attention to that.
And there are a little set of rules that make it a true QCD, and that allows for this treatment. The money has to go directly to the charity. You cannot receive anything in exchange.
You can't get a free umbrella from the public radio station?
Free umbrella disqualifies the QCD.
Oh, this is important.
Another thing that a lot of people miss is you need to get acknowledgement from the charity of the gift. It's not just enough that they get the check and cash it. they actually have to give you an acknowledgement.
Need the letter saying, thanks so much for your donation.
Thanks so much for your gift.
Save those letters, people.
Yes. And if you don't get acknowledgement from the charity, you got to reach out to them and track it down.
And request one. Yeah.
And request one. Now, this only comes into play if you get audited. The IRS does not require you to send this letter in with your tax return.
And these are the things that you should do and tie up in a nice little neat bow in your files and have.
Yes, absolutely.
When Kevin says that, he's not saying don't do it.
Correct.
He's saying, right, you don't need to take action until and unless they come knocking.
Now, there is one more problem with a QCD, and this goes back to donor advised funds. You cannot use a QCD to fund a donor advised fund.
Okay,
now,
that's important.
Like you just said, Stephanie, once you get over the limit, you can still take money out of your IRA and donate it to charity. You can take money out of your IRA, put it into a donor advised fund, and you get to take the deduction, but it's not a QCD.
Mm-hmm. Good to know. Good to know. Okay, so I think that maybe next section, and perhaps the last big one, is what do you do if you don't really feel like you can give as much as you want to today? Because you might live to be 113 and you might need the money. Or heck, who knows what's going to happen, but you don't want to really write that big check or do these other strategies today. There's ways you can take action today to help charities in the future, down the road, right? And here we're mostly talking about, well, you could make a bequest in your will, but you could also do some beneficiary designations. And again, all these dollars are the same to the charity. But when we're talking about your estate planning and things that happen after you pass away, kind of the crux of the issue here is what taxes are your non-charity heirs going to pay on the different assets that you might leave to them? Is that right, Kevin?
That is correct. Yes, it's like you said, all dollars are the same to the charity. They're not all the same to you and your heirs.
And your heirs.
If you leave your IRA, your traditional IRA, pre-tax IRA, to your kids, they have now, with the rules, they have to empty the account in 10 years. They have to probably take annual distributions.
They have to pay income tax on all that money that comes out.
And depending on their age, if they're in their 50s or 60s, we could be talking peak earning, as well as, they're trying to put kids through school, 40s and 50s. They already have high income. Do they really want higher income?
Which means higher brackets and everything that comes with it, right? Bigger tax bills.
Yeah.
So you're saying that if mom and dad have several different types of assets, the IRA, traditional IRA, is the one that kids want the least?
Correct. Yes, it is the least tax-friendly vehicle out there at this day and age for, frankly, all of us.
So if you have a 401k or an IRA and you're thinking about adding a charity as a beneficiary, think about doing it with your traditional IRA.
Correct.
Right? You want to put them in for $50,000 and then you do your split for everybody else? Great. And here's another little thing I'll just put in there. Tell the charity they want to know that you have remembered them in your estate planning. They might ask you to be in their special giving circle, or they want to know these things for their own future planning.
Right. And I'm just going to mention these exist real fast. There are charitable trusts that you can set up, and they can go one of two directions, which is you donate the money in the name of the charity for the charity to the charity. You get an income stream for a certain period of time, even the rest of your life. And then the money, whatever's left, goes to the charity.
Yep.
There's also the inverse version of that, which is the charity gets the income stream over a set number of years. And then when it's done, you get whatever is
the remainder
left.
Goes to your family.
Correct.
Yeah.
Those tend to be estate planning. And given where, again, on the federal level, how high your estate needs to be before you actually have to pay inheritance taxes, this isn't necessarily a strategy a lot of people use, but it does exist.
And I would say there are planned giving experts at the bigger charities, certainly universities. I've got a good friend who works at a food bank. Like, she is an expert in these planned giving type of strategies. So perhaps lean on those experts for the how and the exact ramifications of it, because they certainly want to have these conversations with you if you are thinking of trying to look at interesting ways to be charitable.
But Stephanie, as the resident life insurance expert in this studio, you have some thoughts when it comes to permanent life.
Well, here's a crazy idea. Sometimes we talk to people who they bought life insurance back when they had young kids and a mortgage, and life was more uncertain. And here we're not talking about term life insurance, which is temporary. We're talking about permanent life insurance in its various iterations, right? So you bought this policy, you've been paying on it for years. Now you're looking towards retirement. If you have kids, they're on their own. Maybe you've paid off your mortgage. Why do I need this life insurance? Lots of people surrender their life insurance policies, which of course you can do at any time. But I would caution you to just pause and think about what other creative ideas you could do with it. You could name the charity that you're thinking of as beneficiary, and you could continue to pay the premiums. You could gift the policy to the charity, and maybe, obviously, you'd have to discuss with them. Maybe they would want to continue paying the premiums, right? If it's something your grandfather bought for you and you only pay $100 a year and it's a $500,000 death benefit, that might be a good deal. You could continue paying the premiums, and that would be a gift to the charity because the charity owns the policy. Or here's another thing. A lot of policies have what's called a reduced paid up option. So you've been paying in for years. Maybe it's a $200,000 policy, and the deal is you were supposed to pay it every year for the rest of your life to get the $200,000 death benefit. But you've been paying in for years. You can talk to the insurance company and say, could I do a reduced paid up? And maybe they'll say, yes, if you want to not pay premiums from here forward, we're not going to give you a $200,000 death benefit, but maybe you've gotten to $88,000 of paid up life insurance at that point. So then you could gift a paid up policy to the charity. Nobody owes premiums in the future. They get $88,000 when you pass away. They're happy. You probably get a deduction. Consult your tax advisor on that. I'm not sure exactly how that works. But, again, just another creative way to use an asset. So talk to your experts, talk to the companies, talk to the planned giving experts at the charities.
That's a great recap. Thank you, Stephanie. But before we sign off, I'm just going to throw this out real quick, just because it exists. We're talking about donating dollars in various shape and forms, but what about time? Pretty much, we'll sum it this way. Your time is priceless, but it's not deductible. So you don't get to bill the IRS for the time you've spent working on charity.
Or the miles you drove, right?
Well, you do get the miles you drove.
Oh, you do? Okay.
You do. But it's got to be purely for the charity.
Mm-hmm.
So, cost you absorb, cost you incur may or may not be deductible depending on everything, as you might already see. But you have to document it, and it can't be a split use kind of thing. Oh, I'm going to go to take the kids to Disney World, and while I'm there, I'm going to
work at the food bank for a day or something.
Shut-ins to their doctor's appointments or something like that. No, it's mixed use, so the IRS is going to nix that.
Mm-hmm.
So just be aware that there are some very stringent restrictions or some very precise restrictions when it comes to non-cash contributions to charity.
So even though Kevin's a tax geek, he is not a tax preparer. He is not a certified public accountant or enrolled agent. Consult your tax preparer for all these things.
And as we said in the beginning, by the time this episode airs, Congress could have done something and turned all these rules up on their head. So
double check, triple check. But Kevin, I think the big picture again is maybe there are ways to get some more kind of net dollars to the charity, but having a smaller financial impact on your own situation. It just takes a little bit of looking at it. Talk to your financial advisor, your financial planner, talk to your tax people, talk to the charities, see if there are some other ways you can have more of an impact, but while preserving your own financial stability for the future.
Right. We're talking about basically conserving the cash from your perspective. Charity is happy either way. And the other piece of advice is have these conversations earlier in the year, because you'll have time to pivot and say, oh, well, we don't want to do it this way. Let's do it that way.
Don't be calling people the week before the holidays because they might be on vacation. They might be swamped. Yeah.
Yes.
So we're planting the seeds early in the year. We laud your charitable impulses, and we want to help you make as big an impact as possible. Thanks so much for being with us. We'll talk to you next time. It's goodbye from me.
And it's goodbye from her.
Be sure to subscribe to the show and please share it with your friends. Show notes and more information available at takebackretirement.com. Huge thanks for the original music by the one and only Raymond Loewy through New Math in New York. See you next time.
Investment advice offered through Private Advisor Group, LLC, a registered investment advisor. Private Advisor Group, American Financial Management Group, and Sofia Financial are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. This information is not intended to be a substitute for individualized tax advice. Please consult your tax advisor regarding your specific situation.